I'm Rick Murphy, CEO and founder of Cogent Growth Partners. If you're a technology services provider or an MSP thinking about growth, acquisitions, and how to achieve a realistic liquidity strategy or an eventual exit, this show is for you. This is Cogent Conversations.
Let's pivot now to customer and revenue risk questions, right? Kind of the stickiness. The MSP, should they be asking what percentage of revenue are their top 3 clients?
Absolutely. Gosh, the same conversation from yesterday. One of the things we sent them this morning was we do a lot of pivot tables, which is an Excel spreadsheet thing. If you're not into Excel spreadsheets, I know a lot to be dangerous. That's why I have really smart people working for the company for a very long time.
Much smarter than me.
Have good people that know this better than I, but I know plenty enough to be dangerous. So what happens is customer concentration is really the question you just asked. Do I have a customer concentration issue? And a lot of companies do have a customer concentration issue, right? Some people are more focused on it than others. We do run across that quite a bit. And then the Q&A part of the day is, a buyer looking at somebody saying, hey, what's the concentration really look like from customer, the top 10 customers, the top 20 customers, and I'll spin that back in a minute. But and then inside of that, so let's say you've got a customer that is 20% of your business. Well, so if you lost that customer, 20% of your business walks out the door, can be very difficult to deal with on lots of different levels. I don't wish that on anybody. Even if you never sell the company, losing a big customer is a problem. Mm-hmm. We actually had a lot of that. Weirdly, that was last year. 25 was sort of the year of the key customer loss. We had a number of deals that had to get retraded on purchase price because after the LOI hit, I don't know direct reason why, and certainly not directly related to selling the company, but we had a number of deals where the top 1 or 2 or 3 customer went away and put in their notice that we're going to bid.
Wow.
A lot of times because they got sold, so the customer itself was going through an M&A situation, and the new sheriff's in town and the new people buy the company and they switch horses and change out their IT service provider. So that kind of happened. That happened a lot. We lost a couple of deals last year over that because they just didn't want to. Nobody wanted to play anymore after that. And one of them was a 30% customer.
Wow.
There's stuff you can do contractually to protect each other, the buyer and the seller, in certain situations to preserve the purchase price on the one hand and to preserve sanity for the buyer on the other hand and make sure they're not overpaying or buying a pig in a poke, if you will. So there's customer language and there's things that can help soften that blow. If you already have a customer concentration, it doesn't mean you can't sell the company, and it doesn't mean you shouldn't buy the company either. But you got to be cautious, right? And so the idea of trying to keep no single customer more than 10% of your company would be a good rule of thumb. You'd like to see nothing more than 5-6% of the customer of the company on any one set of customer, on any one customer. And then you don't want to have concentration where all of your revenues in your top 3 customers, your top 5 customers, because again, that's real risky. Boy, if something happened to anybody that owns those relationships, if something happened to any one of those relationships, it can really damage your ability to move your company forward and have a viable company. So what we look at, and a good rule of thumb, is where does 80% of your revenue come from? So one of the measurements we do, and a lot of other buyers look at this similarly, but we do it as sort of we have all kinds of modeling that we do in our purchase price modeling that we do. It's our proprietary model that we use. It's a return on cash model. And one of the most important things is like, hey, we study and do pivot tables and do reports on the top 80% of revenue customers. And what are the percentages of total revenue? How many customers make up the top 80% of revenue? Is it 10? Is it 100? Is it 50? Right? And so understanding that, because that's where the bulk of the business is. The bottom 20%, you're not going to throw the baby out with the bathwater. If those customers are profitable, you're going to want to keep them as a buyer. And they certainly want to get credit for them if you're the seller. But a lot of times, some of the dribs and drabs, teeny companies live in that bottom 20% of your customers. So the other thing to think about there and we spur that again, run the company like you're going to sell it every day, but make profit now, go ahead and make money now, is why are you servicing customers that are actually costing you money? There's a lot of those smaller customers. I would submit that sending them an invoice monthly is probably more costly than the money you're making on them, right? I've got this $500 a month customer. It might look like you're making $500 free, but you're not. You're probably not. Is it possible? Sure. Are there some of those customers out there? Yeah. But is it true that a lot of the 20% or less of your revenue customers are just small customers that, why do you still have them? People don't fire. People have a hard time managing personnel, and they also have a hard time managing small customers that they should jettison. That's what we call it. You and I've talked about it before. We call it top line disease.
Yeah.
That's where top line disease comes from. Because all you're worried about is top line revenue. You're not worried about what constitutes it. You know, I do $5 million. You know, but $500,000 of it is from 1,000 customers who pay me, $300 a month.
Right.
You know, like, wow,
Right.
how many people do you have on your staff that still have to manage those 1,000 customers?
Yeah.
Somebody's got to take care of them, So you probably have more people than you need doing that, and you're probably not making as much money on that as you think.
So generally speaking, 80-20 rule applies?
Yep, 80-20. So you want to be able to, make sure that you got the bulk of your revenue is coming from 80% of your customers.
Right.
And that you're managing the 20% of the customers that are below that line to make sure they're good customers, you're making money from them. And feel free to cycle through those customers and find new ones. Go get some fresh ones. Get rid of I don't want to be too crude. Get rid of the old shitty customers and that you're servicing that aren't making you any money. Help them find a new home if you want to. Doing your parents' IT. Maybe it's time to graduate from that.
I remember in the peer groups we used to say liberate them to a friendly competitor or something like that.
There you go.
Yeah.
Exactly. I like that. That's a good way to put it. That's a great way to put it.
So when an MSP is selling, are they selling the company, or is the buyer buying the company or the owner? Talk about personal loyalty and how it transfers.
Both, right? So, and it depends. It just depends. It really, so you got to back up and go to 100,000 feet is the ownership that is selling or has decided to sell. Because again, we're recruiting people all the time. We're not just looking for companies that are for sale already. We're trying to find interesting people that match and fit with our clientele and vice versa. And most people that are really M&A curious, we call it, are they M&A curious? Their largest asset is their business, and they've been working on it for years, and they've been making perfectly good money with the business. But if it's time to do something else, or what else is there, or maybe I can just slow down a little bit, pull back a little bit, and be just part of a bigger team, and there's other people on the team that I can be helpful to, and just have a just lifestyle choice. But the big picture is really trying to focus on I don't know. I've lost my train of thought.
Are they selling the business, or are they buying the person, or are they buying the business?
Right.
The owner.
Right. So they're buying the business with relationships, and if the owner is able to be part of the new team, I'd rather have the owner be part of our team because they're smart people. They're on, they've developed this business already, and they can help us move the entire new business, the newly formed bigger business, help us move it forward. Most of our larger professional buying clients, most of our larger companies that are then invested in by PE companies, they do their best to try to keep management. They prefer to keep management. They prefer to keep ownership if they can, as long as they're employable.
And are contracts assignable in an acquisition?
It's one of the first things we do and look at in due diligence. We try to do our best pre-LOI to figure that out.
Letter of intent.
Letter of intent. Excuse me, sorry about the jargon. Yeah. So when we do a letter of intent, that's, you've agreed to get engaged, right? And so once you've been engaged, now it's time to do some deeper diving on the due diligence. But we one of our claims to fame, one of the things we do really well is to do a lot of the modeling, a lot of due diligence before the letter of intent happens, so that we have a better than 90% LOI to close ratio, which is pretty unheard of, because we do a lot of the work first. so we don't retrade stuff later and discover a bunch of stuff in due diligence post LOI that makes us want to change the deal, which just upsets everybody. That's not a good way to go. And that happens all the time with broker deals and deals where the people are just out there sort of shopping like it's a meat market. We don't do that. We think more about relationships. But at the end of the day, we think most of our clientele think it's really important for that for them to stick. They don't have to, but it's better, more value. By the way, it's more valuable if you stick around. It's more valuable. That's for sure. Also, you'll get as we don't. You know, I don't use a lot of multiples in conversation, but your multiple is going to go up a half a turn of the screw or something. It's definitely going to be a better multiple if you are part of the solution and not part of the problem.
Again, having that MSP running it like they're going to sell it.
Yep, every day. I have a deck on that. We're not doing that deck at Expo, but we have lots of information on that. We have all sorts of white papers on our website. We're putting more and more up. We've started this podcast with you, which we're really looking forward to doing and talking more about this as the time goes on. We'll be doing this podcast with you twice a month and maybe more often than that, sooner than later. And we're really looking forward to diving into a lot of these subjects and bringing on subject people to come in, meet my partners, but more importantly, meet our clientele and meet we call them candidate companies, not targets, because I think it's rude and disrespectful. The candidate companies that are interested, the M&A curious people that are interested, that have actually worked with us, that have actually sold. We're going to have them on and be talking to them and asking them a lot of questions like this also. And subject matter experts, and can't wait to get other people on this podcast and just talk more about that. This is Cogent Conversations.